You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means we are back. It is time to unleash the bonanza that is TWIFO, This Week in Futures Options. My name, of course, Mark Longo from theoptionsinsider.com, as well as from the network that 18 plus years in continues to grow. What are we on? 3 new shows just in the last half a year, 8 months, something along those lines. Wild that your demand is insatiable. I like it. There's more where that came from, including this week, the Hot Options Report, the latest addition to the network. Yet another reason why you should be listening to the full network. If you're not, man, you are missing out on a whole bunch of goodies out there. And then, of course, if you want even more goodies in your life, if you think you can handle it, if you think you're ready for it, then head on over to the pro, theoptionsinsider.com/pro. Once you're there, that gets you access to supersized pro Q&A we did couple of days ago with Fidelity. You have Options Oddities, which is the official now after party for Vol Views. And then, of course, a whole bunch of other fun. The optionsinsider.com/pro is the place to go to kick down that door and get into the after party known as Options Oddities. As we see who's joining us on the old TWIFO program this week, I am pleased to welcome back our old pal. This can't be right. This says you and I haven't chatted on TWIFO since January 11th. That can't be right. None other than our good pal, Miss Carley Garner from DeCarley Trading. Carley, welcome back to the program. Madam.
Thanks, Mark. And I do believe that is accurate. I've visited some of the other shows, but not this particular show, which is, options are my bread and butter. So I'm more comfortable here anyway. So glad to be back.
Wild. We haven't talked that long. We have a lot of time to make up for. No messing around, Carley. Let's get right to it. A little bit of the old movers and shakers report.
It's time to find out what's rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers Report.
All right, everybody, welcome to the Movers and Shakers Report, the portion of the show where we tell you everything that's lighting it up to the light side, aka the upside, and to the downside over there at CME Group this week. If you look at the full chart, which we do tweet out before showtime, listeners, you will see that it is biased towards the red, but not aggressively so. I'd say it's about 60-40, maybe 65-35 red over green. That said, the largest percentage mover is to the upside. Can you guess what it is? I guess we're going to find out. All right, Carley, you haven't been on this show since January, so you could have completely forgotten how all of it works. You think you can handle a little light side and dark side for the folks?
Sure, I'll try to figure it out.
All right, do your best.
All right, so I'm going to start with the light side because there's obviously some really big movers on here. Coming in at number 5 is Bitcoin up 4.54%. That's wild. That's massive. Soybean oil up 4.77%. Natural gas, something I like to talk about, up 6.47%. And lumber up 7.85%. And we'll go to the final one, palladium up 9.53%. These are really, really big numbers. Very unusual, to be honest. But what I will say is a lot of these markets are coming off of lows. So it's a lot easier to make big percentage gains when you're coming off of lows. So I'll just leave it at that. But these are impressive.
All right. Yes, a lot of action to the light side, including a lot of action in Bitcoin. And of course, our beloved palladium. We've been talking about this one, it seems like, for a while now as well. All right, let's mix it up. Let's go red. To the dark side we go. Carley, what do you got for us this week?
Okay, so number 5, down 2.87% is healthcare. And I know I haven't been on the show for a while, but that surprises me to see that there, just simply because it's a new product.
Yeah,
I've never even charted it before.
A lot of sectors in the dark side this week. That's interesting.
Yeah. Energy down 2.97%. Coming in at number 4, and then we've got number 3, materials down 3.08%. Number 2, this one's a touchy subject for me because we're long. We probably bought a few days early, but soft red winter wheat down 3.09%. And on the final one, we have oats down 6.44%. And if you've been around the commodity market for any length of time, there's a saying that goes around the floor, or goes not really the floor anymore, but the industry, oats knows. Oats often is kind of a precursor to what's about to happen. So oats knows. Keep that in mind.
I like that. Oats knows. I wish Oats knew some options paper. It does like 3 contracts a week, but Oats knows. I like that. Is Oats your leading indicator for whatever you're up to out there, listeners? Hit us up. Let us know as we keep on rolling with the moving and shaking into the world of volatility. Remember, you can run this report for yourself anytime the mood strikes. Just type CME and CVOL into whatever browser you're rocking. That will get you to the CVOL dashboard. Then from there, if you want to line up with the show, go to the aggregates tab and then set the high-low range to 1 week. Once you've done that, you got your brand new CVOL report for this week in futures options. How cool is that? All right, let's get to it, listeners. Let's kick it off. Topping our list this week is the Treasury yield vol, 110 3/4, up about 3 1/3 points today. That is also the high for the week. In fact, that seems to be our narrative with most of the names we're talking about this week, pinning the needle to the upside from a vol perspective. So we're getting a little bit juicier on the vol front, which is kind of interesting given the fact that a lot of assets we've talked about have come in on the vol front of late. Treasuries pinning the needle to the upside. That is the high for the week. The low for their weekly vol range, 94.06. So once again, pretty wide range on the Treasury yield volatility. Below it, we have the metals. Metals coming in at an 1884, up about 0.6 just today. So that's pretty spicy for the metals. If you know anything about metals, you know in aggregate, they're not usually bastions of volatility. So getting north of an 18, threatening a 19 handle, that's nothing to sneeze at. That's also the high for the week. The low was 17.29, so about 1.6 points. Over 1.5 point range on the week for metals vol, all that to the upside. That's a lot. So that's kind of interesting out there. Again, if you've been looking at some of our shows like the Futures Rundown, you've seen that it's a good year to be long some metals in your back pocket. Could be precious, could even be base like copper. Either way, metals have been where the action is this year. Below it, we have the ag products CVOL. 19.57 today. That's pretty much the high for the week. Technically, it was a little bit higher, 19.69 yesterday. The low was 18.98. Below it, we have the FX CVOL, 8.94, up about 0.2 today. That is the high for the week. The low, 8.17. Below it, we have the Treasury CVOL. This is, again, the actual underlying price volatility of the Treasury complex, a different beast than the yield volatility, also obviously much lower. The price volatility, 6.25, up 0.17 today. That is also the high for the week. The low, 5.14, so over 1 point range for Treasury price vol in the week. That's a lot, but then again, we did have that little bit of a dust up yesterday between Powell and the Fed, so obviously that's going to be playing out in the Treasury volatility. Below it, we have the aggregate commodities CVOL, 35.15. This is one of the few that's bucking the trend, coming in at the middle of its weekly range. The high was 35.91 and the low 34.67, so kind of splitting the uprights there. And our lone loser on the week is actually the energy CVOL, 49.73, off a little over a half a point today. That is pretty much the low for the week, the high 51.37 out there. So energy vol coming back to earth a little bit. Interesting stuff out here in the CVOL realm, given how much action there is out there on the crypto front these days and how CME does have a Solana future now as well. Might be worthwhile adding a crypto tab to this aggregates tab, but I guess we'll have to wait a little bit for that. But you don't have to wait any longer for the show proper to begin, listeners. Carley's joining us so that we have to talk some nat gas. And also, nat gas is number 3 to the light side this week, up about 6.5%. So, to the world of energy, we go.
It's time to tap into the deep options well of black gold, Texas tea, nat gas, and more. It's time to talk energy.
All right, everybody, welcome to the wild world of energy. Head on over to cmegroup.com/TWIFO, TWIFO, if you want to see these reports for free. Once you're there in that asset class drop down, go down 2 slots to energy, then you go down 3 more slots to nat gas, and then you're off to the races. Where's nat gas popping off at the start of a show? A little over $3.50 out there, $3.52 to be precise. And is it a banger week out there? It's actually not as wild as we've seen of late. We've seen well over 1 million contracts, 1.2, like clockwork out there. This week, 660,000. Still more than it used to put up. Used to put up about 400,000 in a week. So obviously it's still active, but a little bit of a retreat off the lofty volume highs that we've been seeing out there for a while. Carley, it's number 3 to the light side this week. What is catching your eye in nat gas these days?
Well, obviously, nat gas has seen a nice little run here in the last week and a half or so, as it, numbers don't lie. But the reality is we're still really discounted in natural gas. In fact, we're trading below the 200-day moving average, which is roughly 370 on the August contract. To kind of give you an idea where we are, we had some long option spreads on. We were short puts, long calls, and we've started peeling those off because I don't really trusted it. The way that it's running out of steam up here and coming up against the 200-day moving average makes me a little nervous. So I'm still slightly bullish in the short run, but in the long run, I think if you were lucky enough to have pulled off a winning trade on the light side or on the upside, so to speak, I think it's probably time to pair your risk, because this doesn't feel like it wants to just take off and start running yet. It's probably too early in the year for that.
And you've always got some fun upside ladders, risk reversals, anything cooking in nat gas these days at DeCarley?
Well, we came into the week short puts. We were short, off the top of my head, I believe they were September $3 puts, and then we used the money to buy call spreads. But basically where we're sitting now is we bought our puts back. We took a little profit on those, and we're just waiting to see if the call spread materializes. Because like I said, I think we go a little higher, so I would think it's worth having some cheap call spreads up there. But you don't want to have a lot of downside risk, because if this market does decide to turn the corner, it's probably not going to be pretty. Probably everybody liquidates all at once. On the bright side, if looking at a weekly chart, I think between now and let's say late summer, we probably get some pretty good buying opportunities against the uptrend line on a weekly chart. So if you're flat, probably stay flat and wait to see if we can get something closer to 315 to 320 to put something up on going higher.
It is kind of wild that we're in the middle of summer, Carley, and we're talking nat gas $3.50. Right. Doesn't that just seem wild? Doesn't that seem kind of weird?
Yeah, it's a little weird. Natural gas is known as the widowmaker because it can be pretty treacherous. But if you look at a weekly chart, it's actually really honestly gone nowhere for several months, which makes me nervous that we're basically just probably accumulating some potential volatility down the road. Markets don't stay quiet for long, especially natural gas.
Yeah, this is a wild chart here. Again, nat gas $3.50 north of the 3 handle in July. That is not usual. It wasn't that long ago. Doesn't seem like, listeners, that it took a lot to get nat gas to break $3, and it was a big deal when it did. Now we're hanging out $3.50 middle of July. Again, shows you what kind of interesting markets we're all living through together right now. Like we said, 660,000 contracts on the tape in nat gas right now. So not explosive, pun intended, but not nothing either. The big dog out there, nearly half of that paper, 45% going up in the August contract, has about 11 days to go. So we're going to hang out there, listeners. What is vol in August nat gas, you might be wondering? It's about a 53 3/4, off about $1. Remember, we were talking about energy vol coming in a little bit on the C vol, and we are seeing that in the August cycle. Skew-wise, not a lot to write home about right now in nat gas, which maybe shows, at least for the near term, options markets thinking we're going to settle around this 3.5 strike for a little bit. Last week, the puts were 0.6% discounted. This week, a whopping 0.5, so they haven't really moved at all. The calls last week had a slight bid, 2.3% bid. Again, in the annals of nat gas, that isn't much. And that's all gone now. They're about 0.4% discounted. So I would consider that to be flat. As well, I consider both the puts and calls to be flat right now. So no real indication from the skew that we're going anywhere soon. If we go a little bit farther out, we go out to the end of the year, let's say December, those calls were about 6.2% bid. By the way, that December future's at a 461. So quite the term structure going on there. And the calls right now about 4.7% bid. We go all the way out to January, so winter of next year. You expect that future's at a 492, nearly a $5. My goodness. And those calls are about 11% bid right now. So there is a bid to be found as you go farther out into some of the more seasonally appropriate periods. Right now, a whole heck of a lot of nothing from a skew perspective. But what is lighting it up out there, like we said, 45% of the flow going up in the August cycle, and it's the AUG4s that are dominating the tape out there this week, going up 42, almost 43,000 times. Pretty active all week long, 11,500 on Monday, about 13,700 on Tuesday, and about 10,000 on Wednesday. So opening all week long, 7,500 today against an OI of 33,000. If you're wondering what those are going up for out there, listeners, looks like these AUG4s were trading today for an average price of a whopping 2.6 cents. It makes sense. It's a $0.50 out of the money with about 11 days to go. So I guess if you want a little scratcher, that could be a little bit of a roll the dice money out there. I don't know, 2.6 cents for the 4 calls. Does that float your boat, Carley?
Not really my style, no. I mean, it would take quite a bit of luck for that to pay off. Just so happens to be right on the trend line, the downtrend line. And this is a market that, since March, we've basically been making lower highs. So it's not a market I'd get overly bullish in for, but for 2.7 cents or whatever you said, I mean, I guess no harm, no foul.
Throw a little dice and see what happens out there for 2 cents. All right, and then number 2, we have the 3 puts. So again, pretty much equidistant options. We're hanging out right in the middle of that 4-3 strangle / risk reversal, call it what you will. 37, almost 38,000 of the 3 puts, again August, so the same time frame. Looks like folks bailed on 10,000 of them on Monday, 8,700 on Tuesday, mostly opening there, about 9,000 on Wednesday, again opening, and about 10,000 today against an OI of 37,000. And if you thought the 4 calls were cheap, then maybe you'll like the 3 puts even cheaper. They're pretty much not even a penny at this point, a fraction of a penny. So there you go. If you think nat gas is going to fall out of bed between now and the next 11 days, there you go, about a penny for those. You can buy that whole strangle for about 3.5 cents. So there you go. If you want to throw some money away, the 3, 4, 11-day strangle in nat gas. There you go, listeners. That sounds like some good living. We want to get a little bit closer to the fire. How about the 3 3/4 calls? Also active this week. About 30,000 contracts on the tape. The big day was Tuesday, 8,700 closing there. 7,100 each Monday and Wednesday, both opening. And almost 7,000 on the tape today against an OI of 17,000 contracts out there. So interesting stuff. Looks like we have actually a call fly going up out there today. And it was the 3 3/4, 4 1/4 call fly. Interesting. Looks like they went up about 2,000 times. So maybe somebody looking to buy a little bit of upside, but doing it as the fly instead because they didn't want to shell out the whopping 2.5 cents for the fours. Or they want to get a little bit closer to the at the money. I get it. So maybe I like that a little bit better. It's like the price for that was also about almost 3 cents. So yeah, a lot of weird pricing going up out here. Let's look a little bit farther out, see if we see any other interesting and or aberrant prints. If you like the 4 calls in September, 40 days to go, those were trading about 14,000 times this week. Also, the 3 puts pretty active in October and November with about 16 and 13,000 contracts going up respectively in those months. And if you want to get a little wild, looks like the Jan 2027 6 calls. They have a whopping 529 days to go. They traded 1,300 times this week, listeners. 1,000 of them today. 1,000 of these 6 calls. Again, that future's at $5. So a little bit of a different beast. Jan of 2027. Can you even think that far out from a nat gas perspective? A wild paper out here. All right, Carley, we hit the Widowmaker. Where should we go next? What else is catching your eye? You want to hang out more in energy? You want to talk crude? You want to go somewhere else? I know you're loving wheat right now in the ags. What's floating your boat?
I'm a game for anything. Wheat or crude oil sounds good to me.
All right, since we're already in energy, let's keep the ball rolling out here to crude oil. Pop up in that product family from nat gas. Go up 2 slots to the top of the page, listeners. That will get you to good old WTI. WTI coming in to start the show, 66 1/4, off about 3/4 of a buck, or a little over 1, about 1.2%. Kind of hanging out in that middle of that 60 handle range that we've been talking about for a little bit. It flirts over 70, comes back down. It's been a wild couple of months out here in all things crude. What's catching your eye in crude oil these days, Carley?
Well, so I've been talking about a pretty pivotal level around 65 for a couple of months now. Anytime crude oil has dropped below 65, it's usually been a bit of a bloodbath. We usually drop all the way to the 30s or the 20s, or in one case, which was 2020, we actually went into negative territory. So below 65 is a real danger zone for crude oil. We were trading below 65 earlier this year, and kind of got a stick saved by the violence that was going on in the Middle East. But the reality is the market priced in a reduction of supply due to what's going on in the Middle East, and thus far we haven't lost a single barrel of oil. In fact, OPEC has actually increased production, and I think the US dollar is bottoming. So I could be wrong here, and I know we're trading a little above 65, but I don't think the danger zone is over yet. I think we're just kind of resetting and waiting to see if there's some other shoe to drop. But if we do fall below 65 again, I think it's going to start getting pretty nasty. I'm still of the opinion we're going to see somewhere in the low 50s, high 40s before all of this is said and done.
Crude oil right now, 66 1/4. The paper out here, nearly 46% of that paper going up in the SEP contract. Has about 30 days to go. The vol out here, 30 1/2, off about 4 points on the week. So again, kind of reinforcing what we were saying about the vol coming in on the energy C vol, both nat gas and crude oil vol coming in. Skew wise, not much going on. The puts were about 3% bid last week. That has swung to 1.5% discounted. The calls about 1% discounted last week, about nearly 4% bid this week, 3.9% bid. So a slight bid to the calls, slight discount to the puts. Does that show us we're looking to bounce off of the 65 strike? Not really. It just seems like slight bias to the upside of anything. And it seems like that's shaping up with all this action in the SEP 70 calls. That's where the action was this week. A total of 12,300 contracts, which again shows you that it's kind of a quiet week when only 12,000 is enough to take the top spot in crude oil. Again, the 70 calls trading pretty actively yesterday and today, about 4,600 contracts each, 1,600 on Tuesday and about 1,500 on Monday. Looks like they were closing in the middle of the week, so maybe some folks are bailing on these 70s. They're listening to Carley here and thinking maybe we're not getting back there anytime soon, so they're hitting the exit button. Either way, there's about 16,000 contracts left open on the strike. If you're wondering what these SEP 70s were going for today, they're going for nearly 90 cents, about an average price of 87 cents. So if you're looking to get the heck out of Dodge, there still is some meat on the bone. It's worth selling them if you don't think we're going to get back there anytime soon. Why give up nearly a full dollar if you don't have to? So I could see some argument for bailing on those bad boys. On number 2, we have these 60 puts. And unlike the calls, which were mostly closing, the puts were mostly opening. They traded about 11,500 times this week. The big day was today, 4,500, 3,900 yesterday, 1,600 on Tuesday, 1,200 on Monday, opening all week long. The OI right now, 24,000 contracts. So might be some buying action on these 60 puts out here as well. Let's see if I can find a price for you really quick. Looks like the 60 puts were going up for about 55 cents. So if you bailed on those 70 calls and you like the downside, you like that risk reversal or collar, you could sell the calls for about 87 cents actually, and then buy the puts for 55 cents and still have a credit in your pocket. So kind of interesting there. Again, that's if you're feeling a little bit of downside action out here in WTI. Let's go outside of this really quickly, see if you see any other interesting and or aberrant prints. Not even all the front months. The most active contract, 64 puts going out today, is 1,300 contracts. So there's just not a lot going up. It is the post-July 4th kind of midsummer period, so not usually the hottest time. 7,800 of the double puts have traded in December. So there you go. Maybe a little bit of action on those bad boys. Looks like they traded as part of a 2x3 put spread, the D55-45 put spread, going up 2x3 for a net price of $1.92. That's an interesting one. I'm assuming they're buying 2, selling 3. So if we get down there, they get a little bit longer. They also finance their trade. That's an interesting way to do it. If you want to, I think we're going to be flirting with that level by the end of the year. Interesting stuff out here. All right, Carley, we did our little tour of energy. You did mention ags at the top of the show. They're also in our movers and shakers. Chicago wheat, number 2, off 3.1%. Oats, number 1, off 6.5%. So I think we got to head out there next.
It's time to get our hands dirty exploring the latest options trades and trends in corn, wheat, soybeans, and more. It's time to talk ags.
All right, listeners, pop out of that energy, drop down, go all the way to the top of our asset class list. It is an alpha order list after all, to ags. Then we're going to go to grains and oil seeds. And then we're going to go down, and that's in the product family. And then product, we're going to go down to our old pal, Chicago wheat, a.k.a. SRW wheat, a.k.a. Carley's favorite product on the planet right now. Carley, you kind of touched on it earlier. What's been catching your eye out there in Chicago wheat these days?
Well, obviously the wheat market had this massive explosion a couple of years ago when Russia invaded Ukraine, and that created issues that we're still working out of the market today. A lot of cash came into the market, ETFs and basically fund buying that were long-only funds, pushed the prices to oblivion. And what happened was in the aftermath, as prices came back down to earth, as things settled down, a lot of farmers got caught either underhedged or unhedged and held a lot of wheat in their bin. And so what that means is it took a couple of years for all the bins to get emptied and all the froth to be worked out. And it's been very, very painful for a lot of producers and any trader trying to pick a bottom here. But I think we're finally getting close to working all of that froth out of the system. Speculators have been net short for a while. And I think it's just a matter of time. We're going into seasonal lows at some point here in the next month or so. So what we want to do is we want to make sure that if and when this market finally does turn the corner and start to run, we want to be there. So what we've been doing is buying futures contracts and then buying put options beneath. Right now we're long September futures and long 5-10 puts. This is not a recommendation. I'm just explaining kind of a strategy. That way our risk is limited. So if for something, for some reason the bottom falls out and we go deep into the fours, we're not going to have to worry too much about it. We'll be taking a loss, but it's capped at about 510 as far as our risk goes. And if the market turns and goes up, we all have seen what wheat can do on the upside when it decides to move, and it can be pretty quickly. So we're hoping for that.
I know we talk a lot about energy, and equities are obviously big over there. How big are the ags at DeCarley? You have a lot of customers trading these?
We do. We have a lot of ag traders. We deal with a lot of farmers and ranchers. So some of it's hedging, some of it's speculating, a little bit of both. Ags have been very, at least the grains, soybeans and corn have been relatively low volatility this year and kind of a dribble lower, which is not what producers want to see, obviously. It's a little concerning to me because when I look at, for example, a corn chart, I'm looking at a monthly chart and I can see what, in my opinion, I know this upsets some people, but in my opinion, I think we're replaying the 2014 market. And why that's important is in 2014, we were coming off a couple of years of euphoric rallies that brought us into $7, $8 corn, almost exactly what we saw in 2021, 2023, or 2022, giant rallies. And we've worked that out of the system in 2014. As we were coming back down to a more realistic price level around 4, we had a spring rally that was about $1, and then it started giving that back and it fell all the way into the mid 3s. And if I'm right and we're repeating that, I think the September contract eventually sees 360, 350. So if you're trying to play the upside in corn, the nice thing is the call options are cheap, so you can buy something for very, very low risk. But I personally would wait. I think you're going to get a much better opportunity here in the next couple of weeks. But with that said, if we do see the mid 3s, it's going to be a really great time to start playing the upside in new crop.
There we go. All kinds of stuff going on the ag front. So we started off in Chicago wheat, so we'll hit that. Then maybe we could do a little segue into corn as well, since Carley's luring us to the dark side of corn. Chicago wheat right now, 534 in that front future, listeners, off about 11 handles or about 2% this week, obviously off more if you extend that to our show last week. How much paper is Chicago wheat putting up? About 70,000 contracts. So like a lot of things this week, it's kind of light on the volume front. We've seen Chicago wheat do more than that. The big dog, we're going out to September here, about 36 days. That's where about 45% of the flow is going up. And it looks like the vol in September wheat is about 24 1/3, off about 0.6 of a point. So gives you a sense for relatively where wheat is hanging out from a vol perspective compared to, let's say, the metals or the energy or equities, things like that. Skew-wise, looks like last week the calls were pretty juicy here in this September cycle. They were nearly 12% bid, 11.9%. That is all gone now. They are 4.1% bid. So there was a lot of juice baked into that call wing that is now gone this week. The puts, not much going there, which is also kind of interesting. 3.9% discounted last week, 3.6% cheap this week. So puts kind of treading water. The calls, crazy bid, and then that's kind of gone. What's interesting to see, too, is that it was all in that SEP expiration cycle. None of the other months in the term structure had aggressive bids last week. So kind of makes me wonder if that's a bit of aberrant data. But there could be a report or something else shaping up in that time frame. But it was weird that it would go away this week. But interesting stuff out there nonetheless. And in terms of action, what is the big dog? What is leading the dance? What is the hot option in Chicago wheat this week? It was the SEP pars, the SEP 600s, going up 5,500 times this week, listeners. The big day was Wednesday, 2,500, about 1,000 today, 1,300 on Monday, and about 600 on Tuesday. It looks like opening all week long, so it's like some folks are maybe piling into some upside of past his prologue. Folks are usually buying that upside. It could obviously be overriding, but it seems like the paper tends to flow that way usually. OI, only 7,300 contracts. You're not talking a ton of size on this strike. By the way, if you're wondering, I just had it up. If you're wondering what what the prices are for these 600, these par calls here in September, they're going up for $2.20, listeners. So that's actually fairly juicy, all things considered. So I could maybe see an argument for, if you have some of that, futures or something, or maybe another lower call, writing those against it. It's not like we were talking about those those nat gas calls that are trading for 2.5 cents. Those are actually trading for dollars. So you can get a little bit more action on those. Let's see what else is going up this week. If those are too far out of the money for you, listeners, how about the 540s? Those are much closer to home out there, listeners. Those were trading about 3,100 times this week. The big day, Tuesday, 1,300 and about 1,000 today against an OI of 2,700. About 800 yesterday as well, opening all week long. So interesting to see the action out there in Chicago wheat. And since Carley brought up corn, we didn't get a chance to talk about corn too often. Let's take a quick sojourn out there as well. Where is corn trading right now? 401.75 in that front future. That puts it up about 1.5%, nearly 6 handles on the week. It's obviously not enough to break into our light side top 5. Needed to be up over 4.5% for that, but still an interesting week. Volume-wise, what's corn up to? Corn's actually looking kind of spicy, which is kind of interesting from a volume perspective. Usually corn 400, 450 in that range as well. 541, so corn actually looking kind of active, which is interesting when most of the other products we're talking about here today are kind of light from a volume perspective this week. The big cycle is the SEP cycle here, 36 days to go. That has 31% of the flow. The vol out here, 17.75 in that SEP cycle, which is kind of weird, off 2.25 points. Every other month, the vol is up. So the entire term structure, the vol is up with the exception of September. So kind of interesting. Makes me wonder if there's some maybe aberrant paper going on out there in corn, or just a lot of premium harvesting in corn versus every other month. Either way, that's kind of interesting. Skew-wise, the calls last week, 8.7% bid. This week, about 2.8% bid. So once again, decent bid last week. That is gone now. The puts also had a bid last week. 6.8% bid. This week, 1% bid. So premiums to both wings collapsing this week, which is, again, kind of interesting. Also, vol coming in a little bit this week. A lot of action in this SEP cycle. And it was the 375 puts that were leading the dance out there this week, listeners. Again, this is probably why the vol is coming in. Looks like paper was bailing on these all week long. 5,600 on Monday, 6,000 on Wednesday, 5,100 today, 5,500 on Tuesday. Again, looks like paper mostly selling, or at least closing on those, which probably translates to some selling, hence the vol cratering in this expiration cycle. The 390 puts also active, about 19, almost 20,000 of those this week. The big day was Tuesday, 7,200, again closing. So it seems like we have a bit of a narrative. Folks may be bailing on some downside here. In corn, 6,500 on Monday and about 4,000 today. So interesting stuff out here in corn. We've already spent some fun time on some fun products. Where else would you like to go, Carley? What's catching your eye? Which product category?
I feel like we'd be missing an opportunity if we didn't talk about copper, given the craziness that went on last week with the tariff announcement.
Oh, is there something happening in the metals? I must have missed it. All right, to the metals we go.
Werewolves beware. It's time to explore the options activity in silver, gold, and other shiny things. It's time to talk metals.
All right, listeners, to the shiny stuff we go. Pop out of the ags. You're going to go down all the way to the bottom of the list this time. To the metals. Then we're going to go into precious. But actually, no, I take that back. We're going to skip precious. We're going to get base this time, listeners, because that's where copper hangs out. And, you know, at the end of the day, this year, if you wanted to have a good year so far, just buy some metals and throw them in the old safe deposit box. Could be precious. Those are looking pretty good, but base also looking pretty good as well. Obviously, copper. We've talked on our futures rundown almost the entirety of our top 5. I think with the exception of soybean oil or meal, one of those sneaking in. Other than that, it's all metals in our top 5 right now. So gold, silver having good runs, platinum having a good run, and obviously copper. So a lot going on. Copper, $5.50 right now. Giving a little bit back, giving off about nearly 2% or about 10 cents on the week. But we all know that's just the beginning of this story. These copper tariffs really sent this market into a tizzy. That also probably explains why it's putting up nearly 50,000 contracts this week. It's actually a decent clip for copper. This used to be not quite a trade by appointment, but a pretty light volume options product not that long ago. So nearly 50,000 contracts on an otherwise light week in the market. Nothing to sneeze at. Carley, like you mentioned, it's been a wild time in copper. What's been catching your eye?
Well, so obviously with the tariff announcement, we saw copper do things that copper has never done before. And copper is not the tamest market in the world to start out. So it was really something to see. We actually had positions on. We had bearish positions on. We were short December $6 calls, and we used that money to buy put spreads going into the announcement. So I remember checking it, like our spreads on the morning of before all heck broke loose, and we were up $1,200-$1,300 on a one lot. And I was like, well, that's not bad at all, but everything's going as planned, so we just stuck with it. And literally 30 seconds later, I couldn't believe what I was seeing on my quote screen. So the greatest part about trading options on CME products is a lot of them have micro futures. And so what we were able to do is, I just mentioned, we're short $6 calls, and obviously those, I think we originally sold them for 11 or 12 cents. And they exploded in value. They were worth 40, 50 cents at one point, but they never actually came in the money. And what we did was we bought a couple of micro futures against them to kind of delta out our spread, and we're still sitting with it. I actually still believe it or not. I think that this was kind of just a temporary blip in copper. The market's still working out the tariff. Obviously, it was like a big shift higher in price, but historically, summer rallies in copper haven't really held their gains. It's generally been a time of year where markets tend to roll over. And I know this is different because of tariffs, but let's keep in mind in March, copper rallied pretty sharply, almost to the area we're at now in anticipation of tariffs. But as soon as the stock market went south, copper followed. And I think we might see a repeat of that. So stay tuned. But the volatility is really, really high. The options are, as you mentioned, they used to be very illiquid. The last, let's say 3 or 4 years, CME's brought in some market makers, and they've actually been really nicely tradable product. I will say, like any product that experiences extreme volatility, they got pretty thin during that day last week, but I think that's to be expected. Even the E-mini S&P does that sometimes. So not a product to trade lightly, but also not a product to ignore. There's some liquidity and there's some opportunities there.
Let's check out some of these opportunities. By the way, yeah, you were short those calls. A little bit of sweating going on at DeCarley this week or last week.
There's a little bit of stress for sure.
Not the words you want to hear. Tariff, right when you're short some upside in that particular name. See, it comes for us all, listeners out there. But yeah, we're not breaking a 6 strike, Carley. I think you're good, at least for right now, unless they triple down on some super duper tariffs.
Sure, anything could happen, but that's what the micro hedge is for. So it's pretty great. Product to be. It
is nice to have some bite-sized hedges you can throw in your back pocket.
It is.
That's kind of the argument we hear in a lot of the equity world as well for the 0 day. Things start getting wild against your big position. You throw a little 0 day in your back pocket to hedge it out for the next day or so. You feel a little better, at least for that short window of time. Like we said, copper, a pretty decently active week, all things considered out here, listeners. 47, almost 50,000 contracts. Looks like most of that lining up in September, like we said. And it was the 580 calls. In fact, there were like 2,000 lots of a bunch of things going up out here this week. The 580 calls in September, the 590 calls in October, and the 6 calls in November here. So all about 2,000, which kind of makes me wonder if there's some sort of calendar spread going up. I was just trying to dig to see if I could find any info on that for you. It looks like the 580s in September traded for about 14 cents out there today. The 590s, these are the October 590s talk about. Those are 19 cents. And what were the other ones? The other ones were the 6 even calls in November. Let's see if I can find those bad boys for you as well. Nope, no dice on those. Oh yeah, I did find 6 calls. They were trading 20 cents. So very similar price range out there if they were related. Doesn't look like they went up as a spread, but it's very similar volume out there. 2,000 of each this week. So I guess it's pick your poison, which strike and which month you like for similar price levels at the end of the day. All right, that music means you survived another go-round in the world of futures options, Carley. But before we go, maybe there's a product we didn't get to you wanted to mention really quick, or you wanted to leave our listeners chewing and mulling over something. Have at it, madam. The floor is yours.
Okay, 2 words: live cattle. I've been a commodity broker for over 20 years. High prices always cure high prices, except for live cattle thus far. I don't think this is going to be the only commodity in the history of commodities that don't succumb to gravity, but it sure is giving up a good fight. So keep an eye on it. We're at all-time highs. We're wildly overbought. Sentiment is extreme. Everybody's long. It's just an accident waiting to happen. I just wish I knew when.
I'm looking at these volume numbers right now. You're right, 100,000 contracts in live cattle this week, Carley. So smoking a lot of the other products we just talked about. Again, that's another product. When we first launched this show, kind of trade by appointment, putting up 100,000 contracts. So we are in very different volume regime these days on the futures options front, Carley.
For sure. And I can tell you, there's a lot of hedgers that are probably swapping their short futures hedges for long calls and things like that, because margin calls are running rampant. So it's pretty wild over there.
I mean, it is nice. I'm not going to say our retail-oriented listeners should dive into these markets, but it is nice that it is feasible. There's 100,000 contracts. There's some liquidity out there, which wasn't the case not that long ago. Same thing with copper. You could actually trade it if you were so inclined out there, whereas when this show first launched, I would never recommend either of those to our listeners. So again, shows you how the worm has turned, Carley. And in the meantime, in between your next appearance, which I guess at this rate will be in January again, in between now and then, if folks want to check out what you have cooking in DeCarley, where should they go? What should they do?
You can follow me on social media. On X, it's at Carley Garner. Or you can visit our website. You can sign up for a free trial of our newsletters. Go to DeCarleyTrading.com.
There you go. Check them out, DeCarleyTrading.com. You know where to go. Check out all things CME, CMEGroup.com. Make sure you start your journey at that /TWIFO. That's our reports, after all. And that's where all the data for this show comes from. So if you're intrigued by that, you can run your own reports whenever the mood strikes you. And then once you're there, you can surf around, check out education, research, all kinds of cool stuff there. Now, normally this is where I say that's going to do it for us on the network today, but that's not going to do it. Not in this new world of 2025, where we have new shows popping off left and right. We will be back in about half an hour, usually a little bit after the close, maybe 3:15. Sometime you want to have enough time to process all the data on the day. Why? Because we're coming back for the hot options report. So if you're hanging out in the live chat, make sure you hang out. We'll be back in a little bit to record which of your favorite names. Will they make the top 10 today? Will they make it onto the hot options report? You know what? We cheated yesterday just for you folks, and we snuck in Circle. Will that happen again today? What will make it? Will these crazy names we just talked about on the option block with the Flowmaster, will they survive to make it into the top 10 at the end of the day? Only one way to find out. You got to tune in to the Hot Options Report. You can listen to it live, theoptionsinsider.com/pro, or after the fact, wherever podcasts are available. So make sure you're listening to the full network. You'll get that in your hot little ear holes. Back again tomorrow, noon Central, 1 p.m. Eastern, to talk vol with Carley's nemesis, Mr. Russell Rhodes. Then we're back again after that exclusively for our pro friends, talking unusual activity on Options Oddity. Should be a wild one. Again, if you want to check all that out, theoptionsinsider.com/pro is the place to go. Then we're back again next week. Another great episode of This Week in Futures Options. Stay safe out there, everybody.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.